Hi, everyone. I'm Jerry Davidsey, CEO of Presilium Private Wealth. Welcome to Financial Planning Fridays, our weekly video series on financial planning, where we work to simplify wealth management decision-making for our clients so they can focus on what is most important to them. Today, in our 9th episode, we wanted to talk about estate planning. A good estate plan transfers your assets and investments to your designated beneficiaries in the most effective way possible under the current laws. A good estate plan also transfers your assets and investments in the easiest way for your beneficiaries in what can otherwise be a sad and stressful time. The current lifetime gift exemption for 2022 is $12.06 million per person. Anything gifted above that during your lifetime or when you pass away is susceptible to estate tax, which is currently 40%. Alongside federal taxes, most states also have their own estate or inheritance tax. The lifetime gift exemption is set to decrease to $6 million per person in 2026, but by planning ahead now, you can take advantage of the current larger exemption. This can include setting up trusts that maximize the current exemption available now. One other additional avenue to lower your additional estate tax is to complete annual gifts. This figure adjusts annually with inflation, but in 2022, you can gift up to $16,000 per person without it going against your lifetime exemption and without the beneficiary owing anything in taxes. This means that you can methodically lower your overall estate each year to keep yourself under the lifetime exemption amount, provide your beneficiary the money today, while it may be even more helpful to them, and potentially avoid the beneficiary paying up to 40% on their inherited dollars in the future. There are a variety of other strategies and trusts that you can use to maximize these rules. While trust and estate planning can seem intimidating and overwhelming at times, trusts are relatively easy to set up and something that most people may benefit from having in place. One simple but key part of an estate plan is to regularly check the beneficiaries on all of your accounts. You can name a beneficiary to almost any type of account, and with the beneficiary named, the account will then go directly to this person or entity after you pass away and avoid probate, an often time-consuming and expensive process. It is especially important that your retirement accounts have a beneficiary named, not simply to ensure that your money goes where and to whom you intend, but also because your beneficiaries may be able to continue deferring the tax owed on these type of accounts after inheriting them. So as we approach year end, we all should make it a point to check the beneficiaries on all of our accounts by the end of this year. Unfortunately, we have seen too many examples where people have outdated beneficiaries, leading to situations that could have otherwise been avoided. For example, we've seen people well into their careers whose parents are named instead of their spouse or children on their 401k or other retirement accounts. Other times to revisit beneficiaries are after a birth or death, a marriage or divorce, or really any major life update. We have worked with hundreds of clients over the past 20 years on naming beneficiaries to their accounts in the best way possible, and we are always happy to talk with your attorney and make sure that your accounts here are set up to match your overall estate plan. Please feel free to call us to discuss this in detail anytime. Thank you for joining us today. In our next video in this series, we're going to review our secure Presilium client vault and a few ways that you can use it to maximize your overall financial plan. We can't wait to share it with you soon. Thank you and have a wonderful weekend.